You have to embrace this data-driven culture. At Capital One 25 years ago, we called it the information-based strategy, right? We used data, but we didn't see the entire decision-making process to the data. We incorporate it into what we do. So you have to have a comfort. You can't be intimidated by a spreadsheet or analytics or, using a quantitative approach to making decisions.
Welcome in, everybody. You're listening to Wrestling Payments, a podcast where we help payment professionals contend with the challenges of modernizing their payments operations and identifying ways to build for the future. If you're interested in payments innovation and modernization, you're in the right place. Now, let's get into it.
Hello and welcome to Wrestling Payments, the official podcast of NEACH, the New England Automated Clearinghouse. I'm Joe Casali. I'm the host. As many of you know, Wrestling Payments deals with today's most pressing payment issues and how industry is responding. Today, I am delighted to have Nanci and McKenzie, Executive Vice President of Compliance and Product Strategy with Affirmative Technologies, and James Rowe, Chairman of the Affirmative Technology Board, as well as other things, I imagine. Nanci, could you start and introduce yourself again to my listeners?
Yeah, sure. Thanks for having us, Joe. We really appreciate it and really have a great time working with NEACH and all of your members. So just thanks for having us. Yes, I'm Nanci McKenzie, and I am the Executive Vice President of Compliance and Product Strategy here at Affirmative Technologies. You may have seen me do different sessions at the conferences or webinars, but really today we're really going to be sharing what we believe the industry is really challenged with and those struggles and what they're wrestling with, right? And that is how to come up with a risk rating for originators. And I'm going to then kind of step aside and let James Rowe introduce himself and kind of take us off into that arena and talk about how we can take some punches at what the challenges are that we're having in our payments industry.
James?
Nanci, the wrestling metaphors are great. I don't know that you're allowed to punch, though, are you? It's maybe It's been a few years since I've watched wrestling, but I remember back in the 80s and 90s, Dusty Rhodes and Roddy Piper. Joe's shaking his head. Yeah, those are good days. The one thing that's important about wrestling, it seems to me, is that you need a good guy and a bad guy, right? I mean, that sort of feeds on itself. And in this business, it's the same way. Unauthorized originations are the bad guy, right? Mm-hmm. And so we're doing everything we can to prevent those. Anyway, I appreciate the introduction. I am the chairman of Affirmative. I'm a member of the ownership team. I joined the company about 5 years ago. One of the main reasons that I got involved in this particular business, in this industry, is that I recognized that there was a tremendous opportunity to solve a very important problem with data. And we've been working on that over the last 5 years and have made a lot of progress, and excited to report out on that today, Joe.
Mm-hmm.
So thanks for having me.
Yes, thank you. Thank you for being here. If it helps at all, I think George Bassos is one of my favorite people in the industry. So I don't know if that helps him or hurts him, but.
Affirmative's 25 years old, so it was established, not long after ACH became a thing. And he has, done a lot of great service, both for financial institutions in terms of the risk management applications that he built, but also the payment processing industry. He provides a lot of the technology behind a lot of the bill pay providers in the industry, even today. So he's still with the firm. He's an advisor. He's a major shareholder. He's on the board. He's a visionary in the industry, like Nanci, really. And so we're lucky to have both of them as part of the
Excellent. Tell him I said hi. All right. This was a fascinating topic. I was approaching folks to be on the podcast, and Nanci, I certainly approached Nanci to be on the podcast, but she raised your background. Can you get a little bit into that? Because, when we look at our financial institutions, they have to do an awful lot of things. And every once in a while, they need help, specified help in an area, which I think you really fill. But I don't think it's enough for me to say that. Can you talk about your background a little bit?
Sure. So very briefly, I'm an economist by training, and I specialize in leveraging data and data analytics in a way that helps businesses solve important problems. And I actually got my start after grad school born and raised in Richmond, Virginia, and had joined up with a relatively small credit card company at the time called Capital One in the mid 90s. And actually, then they were small. They had just spun out from Signet Bank, which, was a super regional bank. A lot of those were based in Richmond. It was a major banking center for many years. My dad and my family worked in banking for generations. And one of the things that Capital One did that I helped with a little bit, but mostly learned in the mid 90s was applied data analytic techniques, data sciences to help identify and solve key business problems. If you remember, before Capital One and another firm called MBNA came along in the 90s, credit cards were plain vanilla. All the banks offered the same credit card. The interest rate was 19.8%. It looked the same. It had the same features. It was very hard to get because you had to have a very high credit score to get it. And Capital One really led the revolution in that space in terms of providing things like balance transfers, in terms of balance teasers, in terms of identifying ways to offer credit cards to underbanked consumers, those that, had maybe no banking relationships and had not really had an opportunity to have access to credit in the past. And Capital One was able to do that by analyzing data. And I was able to help them a little bit with that, but mostly learn from some of the really brilliant people that were part of their organization and what they called their information-based strategy. And over the years, I've worked for other large banks, National City Bank in Cleveland, Ohio. And then I joined financial technology providers, Fidelity Information Services, which is the largest, financial technology firm in the world. I was with them for a number of years in both lending and also payments. I'm sure you remember a firm called eFunds. I actually led the eFunds acquisition for FIS in the early 2000s. And so my career has really been about finding ways to leverage data to help our clients. And that helps us financially, of course. It helps us grow our business. But the reason it helps us grow our business is that it enables our clients to be a lot more effective and efficient at what they do. And so that's been the theme of my career. And that brings us to what we've been doing at Affirmative over the last few years.
I love it. I love when we can connect the dots. Great job at connecting the dots. One of the things this podcast does is focus on, the new skills employees at institutions need to learn. I don't imagine they can learn a ton of what you do, but as you look at the future of operations where we specifically focus, but the bank entirely or the credit union entirely, what skills would you suggest new employees or existing employees just dabble in so that when they have a conversation with you, they can understand the terms you're using, the technologies you're talking about? Any advice on that end?
Well, I mean, first I should say that, there are a lot of terms thrown around today, AI and machine learning and big data. And it really, those are sort of very general terms, right? And not very useful in terms of understanding how people are using data to solve problems. The first credit scoring tools, which is really, what we're doing for the ACH industry, with our solutions today, they were built in the 50s and 60s, and they leverage statistical techniques, which the automation of those statistical techniques is really what people call machine learning, right, today. But the techniques themselves, the quantitative tools, have been around for, 80 years plus now. And so I think that's important to remember. And the main lesson is not to be intimidated by it with a score such as, Risk Navigator or the FICO score, for example. It really is just a way to combine different pieces of data into one number that allows someone to make an effective decision, as opposed to saying, well, I see this piece of information, I see this piece of information, and they contradict. What do I do with them, right? The whole approach to analytics is being able to tie all of the relevant pieces of information into one single piece of information. And the process for that, there's complexity to it, right? But it's been around for a very long time, right? And the automation of that is really what's new today through ever increasing computing power. So that's an important thing to remember. But in terms of advice for people in financial institutions, there's a culture. You don't be intimidated by analytics, but begin to embrace the use of data in making decisions. Don't completely eliminate your judgment, right? But you have to be able to temper your judgment in terms of what makes a good originator or a bad originator, right? If you're a financial institution doing an originator review, don't rely solely on your judgment. Find a way to incorporate data into that process to help either prove or disprove that your judgment is correct. And so you have to embrace this data-driven culture. At Capital One 25 years ago, we called it the information-based strategy, right? We use data, but we didn't like see the entire decision-making process to the data. We incorporate it into what we do. So you have to have a comfort. You can't be intimidated by a spreadsheet or analytics or, using a quantitative approach to making decisions. And that's probably my biggest advice.
Excellent. Now, so NEACH is an association where everyone's our friend. We don't really promote anything or talk about any products. But your solution, and you mentioned it a minute ago, Risk Navigator, is so interesting and so, kind of spot on. And Nanci and I talked at the conference, and, through our random talk, she literally went through the whole risk management process. So I just wanted to remind folks of there is a risk management process, assessments and audits. Nanci, do you want to touch on that again? You did a great job at the conference.
Yeah, well, James touched on a couple of really important things, because as the industry has been really developing from the late 90s forward, we've talked about analytics for years and years. And the intimidation behind it, as he was referring to there, I think has kind of stunted our growth a little bit, because everybody has gotten into this pattern of trying to do it manually, using a spreadsheet, because we really don't know how to use the data appropriately to actually allow it to tell us what it is that we really need to know when it comes to the risks that we're exposed to when we're offering payment services to our corporate customers, right? So when it comes to risk management, I had kind of narrowed it down into a couple of sentences when we spoke before, Joe, and I don't know if I can accurately do that again, but I'll give it a try. Risk management is just the need to identify what those risks are and to determine, do I have the controls in place to mitigate those risks to a more acceptable level so that my financial institution can be more confident in knowing that we're going to limit the amount of risk, whatever risk that is, whether that be financial risk or reputational risk, or if it's going to be operational risk or strategic risk, whatever those risks may be, we're going to be able to utilize some automation and some business intelligence and those analytic pieces of our data so that we can be more confident that we're going to have a risk management program that is going to be of a nature that we're going to have confidence that we don't have to do this manually. We don't have to use a spreadsheet. There are solutions out there. And even though back in my day, that's all I really thought I'd ever use, even though I knew analytics were out there, I didn't know how to do it, because you need to have a solution. And we have advanced now in our industry to be able to have solutions and tools at our fingertips. And we really need to look at that because, Joe, as we talked about too, we've got a ACH risk management framework with 9 requests for comments out there, 7 of them being related directly to monitoring those transactions and knowing what the data from those transactions are telling us to try to prevent fraud from going on and affecting our members and our customers within our institutions. It is a must. It's not a should anymore. We have got to have some solutions in place. And James has been a futuristic person that has been looking at, hey, this is a need. This is a challenge for financial institutions. And, just the whole analytics behind what he's been developing is really fascinating. So I don't know if you want him to speak on what some of those criterias are that he's got included in what that vision is.
I do, but to back up what you just said, the request for comment out from NEACH, it's not just another request for comment. It really is a new look at different payments. It's looking at credits. It's suggesting that we should require checking credits as they come in, that they're okay. So I did actually want to jump into it a little bit. I'm enough of a payment geek to, Nanci, you did a good introduction, but how does it really work, the Risk Navigator? What does it look at?
Well, I guess I'd like to just take a moment and explain why I think personally this is an important problem and how we've addressed it. So there are every year around, it's right at $125 trillion in non-cash payments in the U.S. And that's a lot, right? It's extreme. non-cash payment is extremely important to our economy. And of that 125 trillion, about a little over 70%, around $90 trillion, according to the Fed payment study, I think it was done, 22, 72% or $90 trillion is ACH. You think about how important ACH is to our economy. Break that 90 trillion down. 60 trillion are credits and 30 trillion are debits. So those debits and credits come from originators, right? That are served by the roughly 9,000 financial institutions across the country. So it's a huge part of how people talk about other types of electronic payments, but ACH carries the load today and will for a long time. It's huge. And I think people don't appreciate that, how important it is. And what the industry, financial institutions are responsible for doing is making sure that they're originating legitimate transactions. And a big part of that is monitoring and managing the risk of their originators, right? And so that's the background, and that's why we believe, and I believe it passionately, it's a very important problem to solve. Now, what I observed when I came into Affirmative, 5 years ago and started talking with our financial institution clients, which, range from large national banks to local credit unions and community banks, covers the gamut. We have an enormous amount of activity in our system. We see almost $750 billion in payments come through our platform every year. So we have a lot of data. And I talked to the clients because I was interested in finding a way to use that data. And I asked our clients, how do you manage originator risk today? And they said a few things. They said, well, we download transactions into spreadsheets and we try to analyze them. Mm-hmm. There's a lot of transactions to analyze, even for a small financial institution. We go and we get P&Ls from the originators and we have criteria we set up. So what's the basis of those criteria? We don't know. We try to find ones that we're worried about. We do various checks with other institutions to see if they're in the right business. And all of those are sound practices, don't get me wrong. And it's a part of a risk management review program. But what they weren't doing was using the historical data for those originators to predict the future. And so the opportunity that I saw is very similar. Nancy's nice to say that I'm a visionary, forward thinking, but really it's very similar to what Capital One and other financial institutions did in going to credit bureaus, right, that collect historical data on consumers and use that to build credit scores. So FICO score is built on credit bureau data. It wouldn't exist without credit bureau data. We're doing the same thing at Affirmative. We're building originator attributes, originator database that we can then use to build scoring models that help financial institutions predict the likelihood that their originators are going to submit unauthorized transactions into the system. And it turns out we're very effective at it mostly because of the data we have and how we've organized it. We'll, for example, have a data element that says, hey, is this originator nested under a third-party processor? In a financial institution, there's a third-party processor, and then there's the originator. Well, if that's the case, all else equal, that's a higher risk originator, right? Mm-hmm. The amount of transactions that originator puts in the system, how many are credits, how many are debits, what types of NOCs, correction notices come back for that originator. We're able to organize all of that transaction data we collect in a way that then helps us predict that originator's risk of having an unauthorized transaction in the future. And that, in essence, is Risk Navigator. We collect those summary attributes. We'll then go and we'll develop a data set that looks at originators that have had unauthorized transactions. We'll build our scoring model based on that. And then to make it easy for our clients, we don't just give them a score. It's essentially the output is like a FICO score, but then we translate that into a risk grade. We'll translate that into high risk, medium risk, or low risk. And if it's a high risk transaction based on our industry data, another great thing about, I guess being in the Affirmative network is that you can compare yourself to the industry. We've got this great sample of finance. You can see where you stand, but across the industry, a very small percentage, less than 2% of a financial institution's originators are classed as high risk. And what that means is if you're classed as high risk, that originator has a 60% chance, is more likely than not to have an unauthorized transaction in the next 30 days. I mean, that's basically what it comes down to. Mm-hmm. And so what that enables the financial institution to do is not review all of their originators, not focus their risk management techniques or their credit line curtailment on all of their originators, but focus it in on such a small proportion of their clients that allow them to be effective at managing risk, but not treating everybody so harshly, right? So it gives you can maintain relatively generous credit limits for the customers that are low risk because they have a virtually 0% chance of having an unauthorized transaction. So it's a way to automate the review. It's a way to prioritize the review. It's a way to treat the high risk customers appropriately. And it's a way to treat the low risk customers appropriately. And you can set it up in an automated fashion so you don't have to download data to a spreadsheet and do that analysis every month. You just come into, get our business intelligence, and you can get a list of your originators from us that are high risk. You can automate controls and risk manager. There's so many things you can do on an automated basis, and it really saves an enormous amount of time. And it's more effective than a judgmental approach that's based on data that isn't even related to whether or not the originator has an unauthorized transaction. So that's Risk Navigator in a nutshell.
All right. And again, not an endorsement, but I have lots of questions. Where do you use the Navigator? Is it only in the monitoring, or is there part of it's onboarding?
Sure. Well, first I'll say, we appreciate you having us on, and we know that you're agnostic, and we're grateful for that. Like my view is, we'll do fine if we help the industry, right? I mean, that's just how it is, and that's a part of it, right? We're not. It's just, and I think the more the industry pays attention to the benefits of data, the better we get, and the better others get in the industry, right? So we're all about just sharing knowledge and sharing our wisdom, and in an effort not to monopolize it, but in an effort to facilitate a common goal, right? And lift all the boats, so to speak.
Yes.
Yeah. So the way that Navigator can be used is, as soon as we start to see, we have to have a little history for that originator, right? So as soon as we start to see transactions within the first 30 days of a new originator coming into a financial institution, we'll start to be able to give a very accurate rating on that originator. And we start to see what types of transactions they submit. We compare that to other originators that are like them at other financial institutions. And we start to be able to generate some really good analytics. And so from a monitoring perspective, it's about monitoring, but it's also about being able to prioritize, because at the end of every month or the beginning of the next cycle, you want your people that are managing originator risk at your financial institution to be able to go and say, well, if I've got 100,000 originators, I can't focus on them every month. I've got to find the 200 or 1,000, the highest risk group that I really need to be focused on. And so it leads to action. You can automatically curtail limits for high risk originators. You can see which originators were low risk last month, but high risk this month. You can see sort of that transition process that tells you they're getting into a new business. There's no way for you to be able to easily find that if you weren't using this risk classification. Now, for brand new clients to the financial institution, while we don't score like as a part of the application process, or at least not yet, we can tell you here are certain characteristics of originators that are high risk. And that then the right strategy, Capital One, we used to have a strategy for people that we didn't have credit data on called low and grow, right? So we'd bring them in and we'd give them a relatively low credit limit. And then we'd start to see how they acted, how they spent, what they charged, right? You can tell the risk based on that, how they paid us back, right? And then we would grow the credit limit for customers based on that. So that's a great strategy for a financial institution, for an originator where there's not a lot of data. Bring them in and give them a relatively restrictive environment, but then quickly expand that based on, and it allows you to do business with people that you may not be able to do business with currently because you don't have any data on them, right? Mm-hmm. So that's the approach for the new originators that I think is really ideal and enabled by Risk Navigator.
Mm-hmm. Thanks. The reason we developed this podcast was we really wanted to focus on operations and at every level. And we had a committee, the new role of operations committee, and the best, I always seek feedback. Give me feedback. And the blatant feedback was, I need to know what I need to tell my boss to make them look good. So in that spirit, I asked this question: who's the hands behind the product? So who's using it? Who's in there every day? Who's the best user of the product? Is it operations, or I imagine it's someone else?
Well, I think there's, and Nanci may have a perspective on this as well. I'll answer very quickly. I think there's like a strategic perspective, because that to bring this new capability in, because it really changes. It enables a change in the way the operations work, and that needs some executive support, right, or some management support, some strategic support. Specifically, if a financial institution wants to scale, and you need to be able to scale just to meet current market demand. I mentioned 90 trillion in ACH. 3 years in 2018, I think it was like 60 trillion. So it's growing like amazingly. So even if you're staying like with the market, you have to be able to handle more ACH transactions and more originators. And you don't want to double your staff if you double your transaction volume. It doesn't make sense to do that, right? So there's this strategic perspective that says we're going to use more automation. We're going to use more analytics, things like Risk Navigator. And so then it redefines what your operators do, right? So there's a COO decision, there's a CFO decision, because a lot of this data now goes to the board where they can see how they compare to others in the industry, and there's more of a strategic tracking. So there's that customer base, but then within the financial institution, on a day-to-day perspective, there's got to be the SVP of Treasury Risk Management or Treasury. There's got to be a VP of Operations, and then they're the people that are analyzing it today. They go from being spreadsheet jockeys, just to more using their judgment about clients, because now they can focus on the right clients because we're telling them here are the ones you need to focus on. So it's really enables a pretty broad change and a great lift of efficiency across a financial institution.
Nanci, any insights on that?
Yeah, definitely. So yeah, he really hit on a couple of key things, and that is you can't double the size of your transaction load and expect that you're going to double the size of your staff. You just can't find those experienced people in our industry, and you've got to really consider those types of issues that you don't have time to train somebody new coming in. So looking for some solutions is really critical and very important. But as far as who is it that really are looking at this, there are all kinds of examples that we are seeing from the regulators, the OCC, the Federal Reserve Board of Governors, that they're coming in and they're asking these financial institutions, how are you risk rating your customers? How are you risk rating your members from the NCUA? And they are doing enforcement actions. Go out there and look at those regulator websites and the enforcement actions. And it is about risk management, risk management, risk management. There's some prime examples of recent enforcement actions that have come out from the OCC, where the board of directors have got to sign these lengthy agreements. There's one that's 21 pages long, and it's all about risk management, and the board of directors are ultimately responsible. So if we're wondering how are we going to make the impression to the C-level, like James was just mentioning, that the SVP of Treasury Management Services and these types of things, it doesn't take but a second to go out there and look at some of these enforcement actions and see where the importance is on the regulator side of things, that we have risk management in place and that it's operating as it is intended, because we have got to try to maintain this security and reducing the risks that our financial institutions, it's critical for our economy that the financial system is going to stay intact and strong enough to be able to handle the doubling of the size of like he says, it's $125 trillion. I mean, come on. We've got to have some risk management in place. It's just, there's no other option.
Mm-hmm. So I did a session on it's payments or management by the numbers, or payments management by the numbers. And those numbers are real. And I actually did my session before the latest numbers came out. ACH, I don't know if you can say this won, but ACH won this round. We grew the most. All right. The ACH grew the most. I'm not the ACH.
Well, yeah, it's the Fed payment study. I mean,
Yeah.
it was they do it every 3 years. I think it was based on data in 21, but it's come out fairly recently, and they look at this every 3 years, and I think it grew from 90 trillion to 120 overall, like all non-cash, but the 90% of that was ACH.
Mm-hmm. And if you want to find out more, it's the Fed study. It talks about ACH, cards, wires a little bit.
No, I'd excluded wires, but wires they're important, but they're usually a very small percentage of the transaction volume.
Okay, and I think I have a trick question, but I'm gonna almost bet I don't. Pet peeve and frequent member question: reporting to the board. Between reporting to the board and our board has given the responsibility of risk management to a risk committee. Do either of you want to comment on the thought of dedicating the risk management decisions to a committee and not the board? And do you have board reporting? Because it's almost a number one question.
Yeah, so I definitely want to comment on that because, I've done audits, risk assessments for years. I worked for another payments association before I came to Affirmative. And there are many times where the board of directors do not want to take that responsibility simply because they really don't understand electronic payments overall. They're good businessmen, right? They're good businessmen.
Sure.
And so they may put in their policy or may not, but they should have in their policy, if they're going to delegate the responsibilities of the risk management and oversight of an entire program, it should be in their policy stating that, okay, we're going to give the responsibility to the audit committee. But here's the key. They are ultimately responsible for the risks of the institution overall. There is no getting around that. It is their responsibility, and they need to know what is going on under their noses. I know that everybody has heard about the Wells Fargo 2016 problems, and it just continues to keep going on and on and on, right? They just keep getting more and more fines. What was the big thing behind it is that they didn't have oversight over the entire program. It is the prime example of why it's so important that your board of directors know what's going on. And how do they know? By giving them reports that are going to show them what it is that the activity is on ACH, wire transfers, RTP, whatever the payment channel is. They have got to know about it. And reporting is so very difficult. Why? Because your data is scattered all over into all of these different systems. Every financial institution has core online banking, archive system, loan servicing systems. It's all over the place. How do you gather all of that data together so that you can actually give them, here's what our activity is? And that, I think, is a key that people need to understand, that their board of directors, regardless if they want to pass it on to somebody else's responsibility, they're ultimately responsible for it.
James, any additions? That was great.
Well, just in terms of the reporting, I think Nancy's right. And in terms of the responsibility, in terms of the reporting, what we enable, we'll take the NEACH files, the actual submissions, and that's all we need to get. We get the returns, we match them, and then we create all of the reporting that goes to the different levels of the organization. And without that, a financial institution has to invest to build it out themselves, right? They've got to invest in building out the databases to aggregate transactions under originators, to match returns, and then the reporting on top of that. Instead of just sending, we'll take out of the core, we'll just take the NEACH files, and then everything else is automated from there. So it makes it a lot easier, to have a provider like us that, that can do that for you. And it enables a broader perspective that, strategic management, whether it's the board, whether it's the C-level, whether it's SVP in charge of a department, it enables a more strategic perspective on how are my return rates trending over time? How do they trend by SIC code, right? SEC code? How do they, how do they evolve? What types of payments am I making today? You really can't do that with just the payment file. We aggregate all that and provide it back. So it really opens a lot of bandwidth in terms of understanding how your business is evolving to be able to use that type of service.
Excellent. Thank you. Thank you very much. We're getting to time, but as the podcaster, I'm listening and I'm participating. And as I listen, it sounds really like an infomercial, but these challenges are real. We get that question all the time about reporting to the board. We get originators just starting up. So they ask all these questions. And I think it was good to bring out how the process works so that they can, even if they start with the spreadsheet, they can understand these are the key numbers I should be looking at. I want a little bit of a bonus episode or bonus feature. James, you said you were an economist by trade. As the economy right now, interest rates going up, debt ceiling issue happening, what variables could an institution be watching to say, oh, things are going bad? Things are going, something's increasing, something's decreasing. Any insights for the bankers in the audience?
Well, I mean, I guess there's, not necessarily specific to payments, but obviously a continued increases in interest rates are really going to put a lot of strain on the balance sheets of banks because, and it's almost like there's been going out of the crisis in 2008, which I was actually working with a mortgage technology provider it's called Lender Processing Services. Then it goes by Black Knight today. It was actually spun out from FIS. So coming out of that, a lot of banks were prohibited from holding higher risk investments. Subprime mortgages, for example, on their balance sheet, but then they had to transition to holding government debt. Now, the problem with that is when interest rates go up, that government debt becomes worth less, right? And to the extent there's a debt ceiling crisis, which I think is a little bit overblown, but that's a whole other podcast. To the extent there's that continues to make their assets worth less, and people that see the bank with assets that have less and less value are going to go try to take their money out of that bank. I mean, that's fundamentally how it works. And so I think my view is that if interest rates aren't increasing anymore, if the Fed takes a pause, I think the economy is in good enough shape that banks will be just fine. I think some of the hype is overblown, which is a good opportunity for you if you want to invest in bank stocks these days, because I think they're undervalued.
Excellent. Well, so that's going to be the end of the podcast, but any final words, any thoughts, any things people should keep in mind as they're working with originators?
I would just say our goal here, we'll do fine with our business and our product, and we're not here necessarily to sell that, but to talk about the importance of data. We love the conversations. We learn from people like Nanci. She learns from people like, our customers. And so to the extent we can facilitate that dialogue and open it more broadly, we're big fans of that. So thank you for facilitating that process in our industry.
Excellent. Nanci?
Yeah, well, again, just thanks for having us and allowing us to kind of share what we see in the industry and how we, really feel that the solutions that are needed and the challenges are real. And we know that people struggle with all of these types of issues. And I talk about it every day to financial institutions all over the country. We're all in this together, and we've got to just really try to figure out how it is that we're going to be able to continue to grow, because the industry is growing. So you're either going to go along with it or you're going to be left in the dust. So, right?
Yeah, that was good.
Going to probably be eaten up by another big corporation of some sort. So, I say this because I've got a couple of teenagers, and, I think if you ask anybody from the age of 18 to about the age of 35, if some of these entities, such as, I'll just throw out a couple of names, SoFi, Chime, are they banks? They'd probably say, yep, they're banks. No, they're not. They are not banks. And those are going to be our challenges as financial institutions in the payment space. If you're going to stay in the game, are you going to need to know how to manage somebody like Chime or SoFi or Dwala or whoever that might be that is offering banking services through you? It's going to be a challenge. We're going to have to be keeping our eyes open, because it is going to be a bumpy ride. Right?
Excellent. Yeah, no, I agree. Thank you. All right. Well, I'm going to tune off now and say goodbye to my listeners. So thank you for listening to Wrestling Payments. I've been throwing out the press all the buttons, but subscribe. It helps the channel grow, and set an alert. We're going to have more episodes coming out more frequently. I can't pick a favorite. They're all good. So if you like what you heard, tune in again, subscribe, tell your friends. We really are here to help really finite universe of payment professionals. And if you have ideas, let us know. Thank you.
On behalf of NEACH, your trusted resource in payments, and our guests, I'd like to thank everyone for tuning into the podcast. If you've enjoyed this episode and want to hear more about payments innovation and modernization, you can find the Wrestling Payments Podcast on the podcast page of NEACH.org or wherever you subscribe to podcasts. Just search for Wrestling Payments in your podcast app. Thanks for listening.